Spain, where the country passed a crucial litmus test by investors today. After its much anticipated bond auction saw a stronger than expected demand, Spain managed to raise something like 2.54 billion euros from the bond sale. That is slightly more than the initial targeted amount of 2.5 billion euros. But the success has come with a price, as borrowing costs have soared dangerously close to the 6% mark. That is for the 10-year bond that it sold earlier in the day. Most economists believe that anything above 6% will be unaffordable in the long run. Spain has now raised half of its gross target for this year, making the most of market liquidity after Europe's banks took more than €1 trillion of LTROs, or long-term refinancing operations, from the European Central Bank in December and a second time again in February. All right, to make more sense of what the outcome of the Spain auction was, what the impact of that on not just Spain but also on the financial markets is, and to discuss a lot more than that, we've got Jane Foley, who's a senior currency strategist at Rabobank. She joins us on the show from London. Now, Jane, to begin with, Spain's auction of 2-year and 10-year paper has gone through. The 2-year yield is lower than last time. The 10-year yield is a little higher than last time, though slightly lower than the 6% that most analysts were expecting. What does that really tell the markets?
Well, it tells the markets that for the time being, Spain has a little more time before the pressure ratchets higher. But we do suspect that the pain in Spain could actually increase further into the spring and into the summer. If you look at the banking sector, well, we know that there are recessionary conditions in Spain. The IMF earlier this week predicted a 1.8% contraction in growth this year, and beneath that, of course, is the dire position of the property market, meaning that the market will still be concerned about bad loans in Spanish banks. So, yes, Spain has come a long way in terms of consolidating some of those smaller banks, but the market is concerned as to whether or not the FROB really does have the funds to pull the whole of the Spanish banking sector through what could be still quite a painful few months to come.
Right. Jane, now tell us, after today's bond auction, how are you viewing the US dollar?
Well, the US dollar remains a safe haven currency. We certainly saw that proven after September last year, when the Eurozone crisis pushed into a higher level of stress. At the moment, or certainly since the start of this year, because of the calming impact of the LTROs of the ECB, the dollar has performed quite poorly. In fact, after the Japanese yen, it is the worst performing G10 currency in the year to date. And of course, if we look at US policy, well, we have a very accommodative position from the Fed and very dovish comments from Bernanke in the last couple of months. So the dollar is a soft currency on the back of that dovish position. It could firm if we do see a move higher into the stresses of the Eurozone crisis, but for now it is a relatively weak currency, and those conditions are likely to prevail in the near term.
Now, Jane, even if Spain insists that it can finance itself in international markets and says it will not need a bailout like Greece did, do you believe it may be forced to take the help of the European Central Bank in bailing out its banking system?
Well, it certainly could. I mean, as we were saying, the stresses in the banking sector are unlikely to go away this year. The market will remain concerned as to whether or not Spanish banks really do have access to liquidity going forward. But of course, it's not just the ECB that will be in a position to help. The ECB, or some members of the ECB, have become a little more hawkish. Some members of the ECB are suggesting that the ECB has done enough. Now, interestingly, we have had the IMF suggesting that the bailout fund of Europe, the ESM, should be allowed to directly recapitalise banks. Now, of course, we haven't had an agreement from European politicians that that should be the case, but it is potentially an alternative to using the ECB as the main firefighter in the crisis.
Now, Jane, the International Monetary Fund has warned that the balance sheets of European banks look set to shrink by something like $2.6 trillion by the end of next year. In its Global Financial Stability Report, the IMF has also said that unless officials improve their policy response, European banks would dump almost 7% of their assets by the end of next year. The fund says it expects most of the deleveraging to come from the sale of securities and non-core assets. It also sees credit supply shrinking, by 1.7%. The fund's analysts predicted the deleveraging process would be more severe than previously anticipated. The report says the risk of a synchronized and large-scale deleveraging could spark financial instability and hit economic growth across the region. All right, now Jane, just bringing it back to you, the IMF commenting on the need or the likelihood of European banks deleveraging to the extent of $2.6 trillion over the next 18 months. What would you make of it? And again, would you say that this view that the IMF has taken is extremely pessimistic? And would you say that the 2.6 trillion number that they're talking about somewhere seems a little exaggerated?
Now also, if we look to the banks, well, there's been a lot of blame already shifted onto the banks for not necessarily doing their part in helping the global recovery because they haven't been passing on liquidity or passing on credit as quickly as some politicians might like them to see. But of course there are pressures on the banks to reform practices, and therefore it does seem that whilst the IMF's numbers arguably may be perhaps a little bit too high, nevertheless it does seem that a drag from slower credit growth does seem to be a reasonable outlook, and therefore again it suggests that politicians in Europe should be thinking about growth or pro-growth policies.
Now, Jane, Fitch Ratings has sounded out a warning on the health of the Dutch economy. Do you worry that the crisis could be spreading even to the safer economies in the Eurozone?
Well, I think those worries became quite clear really last summer when France, first of all, was being considered because of its exposure then to Greece. Yes, we certainly have had over the last few months concerns about the pace of Dutch growth towards the end of last year, and also we know that there is a high degree of debt within the consumer sector because of tax policies which make it attractive to have large or larger mortgages. So yes, there are concerns with respect to the Dutch economy in that respect. Also concerns, I suppose, with respect to France, particularly after the May 6th presidential election results. We're not 100% sure what that will mean for Europe going forward. So yes, there are a number of concerns, meaning that it's not necessarily just Spain, Portugal, Greece and Ireland which could be the cause of concern later on this year.
Now, Jane, the G20 meeting of finance ministers and central bank governors kicks off Friday in Washington. Are you expecting anything positive for the financial markets coming out from there?
Well, of course, at the start of the financial crisis, we go back 5 years or so, there did seem to be a consensus arising out of the G20, which certainly gave them extra clout. But what we've seen more recently is a lack of consensus. Obviously, once the crisis came off its peak, the national interests seem to again dominate the agendas of most politicians, as you may expect. And that, of course, has diluted perhaps the impact of the G20. Nevertheless, it is very likely that the G20 will discuss pro-growth policies once more. They have previously indicated that it should be the responsibility perhaps of surplus countries to do more to engineer domestic demand and therefore help more the countries that are suffering recession and structural reform.
Jane Foley, many thanks for coming in on the show and walking us through your outlook for Europe and also helping us understand the implications really for Spain and the larger financial markets in Europe are based on the success of the long-term bond auctions that Spain conducted earlier today.